Over the last few years, the car wash quietly became the most hyped small business in America. The pitch is almost too good to argue with. Recurring monthly memberships that hit your card whether you show up or not, a long automated tunnel that does the work while the owner sleeps, and profit margins that supposedly embarrass real estate. Influencers filming next to rented Lamborghinis call it the perfect passive income. Private equity calls it recession-proof. At least, that's the story everyone keeps repeating. But the people actually buying these tunnels by the dozen know something the people posting about them online don't. And that one thing is the difference between the smartest money move you'll ever make and the most expensive mistake of your life. Start with the price because that's the first thing everyone wants to know. If you want to own one of these modern express car washes, the long tunnel you drive through while the machine does all the work, you're not buying a $5 service. You're buying a piece of commercial real estate with a conveyor belt running through the middle of it. And depending on the land, building one from the ground up runs somewhere between $3 and $7 million. The equipment by itself, just the conveyor, the spinning brushes, the giant dryers at the end, can cost more than $1.5 million before a single car has gone through. So right away, this isn't a side hustle. This is a small fortune poured into a slab of concrete next to a gas station. And this is where almost everyone makes their first wrong assumption. They look at that tunnel and they think the business is washing cars. It isn't. The washing is almost an afterthought. The thing that turned a boring roadside car wash into the most fought-over small business in the country has nothing to do with soap or water at all. It's that little plastic sticker on the windshield. Because somewhere in the last decade, somebody realized you could stop selling car washes one at a time and start selling them the way Netflix sells movies. One flat price every month, wash your car as often as you want. And the moment that idea caught on, the whole industry quietly changed shape. The people building these tunnels weren't really in the cleaning business anymore. They were in the subscription business. They just happened to use water to do it. And once you understand that one shift, you understand why billion-dollar investment firms suddenly couldn't buy these things fast enough. Here's the math that quietly rewired the whole industry. A single car wash might run you $15. Nice, but it only happens when your car is dirty and you happen to be driving past. So the operators offered a different deal. Pay around $30 a month and wash your car as many times as you want. On paper, that sounds like a steal for the customer. And for some people, it is. But watch what it does for the owner. Once that little sticker is on your windshield, you get charged every month whether you come through 4 times or not at all. And here's the quiet part. Each extra wash costs the business almost nothing, roughly $1 in soap, water, and electricity. So a member paying $30 who rolls through 4 times is still handing over nearly pure profit. Multiply that by thousands of windshields and you stop running a car wash. You start running a subscription empire that happens to spray water. Meet Mr. Car Wash, the biggest operator in the country and the only one trading on the stock market, which means we can actually see the receipts. By the end of last year, the company was pulling in just over $1 billion a year across more than 500 locations. It had 2.3 million people signed up on monthly memberships, and those memberships made up nearly 80% of all its wash sales. Not a side feature, the whole business. That's the number that turned heads in finance. A car wash sounds like a sleepy local shop. A subscription product with 80% recurring revenue and margins that fat sounds like software. And Wall Street pays very differently for software. Which brings us to the part where the suits showed up. Between roughly 2019 and 2022, private equity firms and family offices poured more than $10 billion into American car washes. Not into one chain, into the whole category, snapping up local operators the same way they'd already bought up dental offices, veterinary clinics, and trailer parks. And these were not small checks. In the summer of 2024, the investment giant KKR put $850 million into a chain called Quick Quack. Warburg Pincus scooped up a Florida operator called L Car Wash. And in early 2025, a company backed by Oaktree Capital bought the Take 5 car wash chain for $385 million, instantly creating one of the largest express operators in the country. At the peak of the frenzy, bankers reported washes selling for 18 to 20 times their annual earnings. In plain terms, investors were paying roughly 20 years of profit up front for the privilege of owning one. That's the kind of price you pay when you've convinced yourself the future is guaranteed. So why were the most ruthless money managers in the world this eager? Part of it is the recurring revenue we just talked about. But there's a second reason, and it's the real engine behind the buying spree. Quick thing before we get into it. If you're finding this breakdown useful, consider subscribing because this channel takes apart a different money trend every week. Now, that second reason. The car wash market is enormous and almost comically disorganized. There are roughly 60,000 car washes in the United States, and the vast majority are owned by individuals. One person, maybe 2 or 3 locations, no big company behind them. Add up the 50 largest operators in the entire country, and together they control only about 8% of the market. To a private equity firm, that fragmentation isn't a problem. It's the opportunity. The strategy is called a roll-up. You buy dozens of small independent washes one at a time, put a single brand on all of them, run them from one back office, and suddenly a pile of mom-and-pop shops becomes a regional powerhouse worth far more as a group than the sum of its parts. And the running costs make it sweeter. A modern express tunnel barely needs people. The machine does the scrubbing and the drying, so a busy location often runs with just 3 employees on site at a time. One taking payment, one loading cars onto the belt, one wiping down in the lot. Low labor, recurring revenue, and a fragmented market begging to be consolidated. For an investor, that's close to a dream. So the obvious question is, does this work for a normal person or only for billion-dollar funds? Time to run the real numbers. Let's say you actually build one. A strong express location can bring in somewhere between $1 and $2 million in revenue a year. The very best sites push past that. Labor is low, and once the building is paid down, a healthy chunk of every membership flows straight to the bottom line. This is where the passive income crowd online gets very excited. You'll see videos promising margins of 50, 60, even 70%, and payback in under 2 years. And in a perfect location, perfectly run, those numbers can technically happen. But notice who tends to be quoting them. Equipment sellers. Brokers trying to sell you a wash, franchise marketers. They're showing you the dream scenario, not the average one. Across the whole industry, real net profit margins land closer to the mid-teens. Still a good business, just not the money printer the highlight reels promise. And there's a catch hiding underneath all of it. Most of that build cost was borrowed, and many owners pulled their land money back out through deals that left them paying steep monthly rent. So the moment that steady stream of cars slows down, the math can flip from beautiful to brutal very fast, which is exactly what started happening. For all the billions that flooded in, the car wash boom has started to spring some very public leaks. Meet Zips Car Wash, once one of the largest chains in the country. In early 2025, Zips filed for bankruptcy. The company was buried under more than $650 million in debt, with only about $1 million in cash to its name. Its lenders ended up taking control of the business, and the causes read like a warning label for the whole industry. Years of aggressive expansion, rising interest rates that made all that borrowed money far more expensive, and those same land deals that locked owners into rent they could no longer cover when growth stalled. And Zips wasn't an isolated stumble. Around the same time, Driven Brands, a large public company, walked away from American car washes entirely, selling off its chain to refocus on oil changes. When one of the big consolidators decides the category isn't worth the trouble, that says something. Then there's the simplest problem of all: too many washes. For a few years, operators were opening close to 900 new locations every single year, often stacking them onto the same busy intersections. The result is saturation. Drive down certain stretches of road now, and you'll pass 3 or 4 express tunnels within a mile, all fighting for the same cars, all tempted to slash prices just to fill their lanes. Industry surveys now rank saturation as operators' single biggest fear heading into this year. And the buying wave has cooled hard, with deal activity dropping by nearly half. So where does that leave you? Standing in the parking lot with $2 million and a decision to make. Here's the verdict, and it's split right down the middle. The opportunity is real. The membership model works. People keep paying, demand is steady, and a well-chosen, well-run wash in the right location can be a seriously good business. That part was never a lie. But the easy money is gone. The version where you buy a tunnel, do nothing, and watch the cash roll in only ever existed in the highlight reels. What's left is a real business, with real debt, real competition crowding onto every corner, and real risk that the cars slow down faster than the loan payments do. Remember that pitch from the very beginning? The machine that runs itself while you sleep. Recurring income, recession-proof. For the operators who got in early, in the right spots, a lot of that came true. For the ones who showed up late, paying peak prices in crowded markets, it's looked a lot more like a very expensive way to sell a $1 wash for 30. No guaranteed profits, no effortless passive income, no machine that prints money while you do nothing. Just a business, like any other, that rewards the people who actually understand what they're buying.